A consistently profitable day trader doesn't stare at a screen for 8 hours. They execute a highly structured routine, extract their profit, and close their laptop before 10:15 a.m. We are going to build a complete micro intraday system. By applying a single technical indicator called the 44 Simple Moving Average, you will have strict rules for exactly where to buy, exactly where to sell, and exactly how much risk to take on every single trade. Step 1 is assembling your tools. You need 3 things: a funded brokerage account, basic charting software, and a blank spreadsheet to calculate your position size. Step 2 is isolating your targets. We completely ignore the thousands of volatile penny stocks available. You must restrict your watch list exclusively to the Nifty 50 or Nifty 200. We only trade highly liquid, high-volume companies. Imposing these hard limits on both your time and your asset selection filters out the noise. Operating within a strict, predefined universe separates professional execution from random gambling. Your trading day actually begins the night before. Around 9 p.m., while the market is closed, we conduct our preparation. Doing this at night removes the panic of the morning bell. This chart shows a standard 5-minute or 15-minute price view. We apply a single overlay, the 44 Simple Moving Average, or SMA. This line averages out the last 44 periods of price data to show us the true direction of the stock. We are looking for the law of gravity to work in our favor. When the 44 SMA line is sloping upward at a 30 to 45 degree angle, it indicates strong, established upward momentum. A stock in this state is highly likely to continue rising. This visual compares our required environment against a dangerous one. If the moving average line is flat or falling downward, the momentum is dead or against you. We never trade these conditions. Your nightly screening criteria is simple. Scan your Nifty 50 watch list to find a stock whose final daily closing price ended right next to a clearly rising 44 SMA line. Once you find it, add it to tomorrow's action list. Securing these targets at 9 p.m. means your morning decisions are entirely premeditated. You are following a logical script, completely insulated from the emotional swings of the live market. Knowing what to trade is useless if your sizing is wrong. Guessing how many shares to buy is the fastest way to wipe out your entire account. We use strict mathematics to protect your capital. This spreadsheet tracks our exact risk parameters. Step 1 is defining your total capital. Let's assume you have an account size of 100,000 rupees. Next, decide your maximum acceptable loss, say 20,000 rupees. We take that 20,000 and divide it by 60 possible trades. This dictates that your absolute maximum risk per trade is exactly 333 rupees. To find your exact share quantity, you divide your 333 rupee risk limit by the difference between your target entry price and your safety stop loss. If your entry is 100 rupees and your stop loss is 95, your risk is 5 rupees per share. Divide 333 by 5, and you are allowed to buy exactly 66 shares. By locking in this math, you create a structural safety net. Even a streak of bad trades will only result in controlled, calculated, and highly manageable losses. At 9:15 a.m., the market opens. You load up the exact stocks you filtered the night before, and you ignore everything else. This chart shows the live market open. We wait patiently for our specific trigger. The first or second 5-minute candle of the morning must form right near our rising 44 SMA line. We are watching for a strong bullish candle. A thick green body indicates a sudden, aggressive imbalance where buyers are overpowering sellers, proving that the upward momentum is active. The moment that trigger candle closes, you place your buy order strictly above its highest price point. Immediately, you place your stop-loss order directly below the lowest point of that same trigger candle. If the price breaks down, you are automatically pulled out of the trade to cap your loss. This visual overlay displays our final rule, a strict 1 to 2 profit target. If your risk zone from entry to stop-loss is 5 rupees, your automatic sell target is positioned exactly 10 rupees above your entry. You are aiming for double the size of your risk. You must not chase a moving target. If the stock opens with a massive gap upward, completely leaving the moving average line behind, the setup is void. You abort the trade and move on. Applying these precise entry points, stop losses, and profit targets takes the chaotic movement of the morning market and forces it into a clinical, predictable set of boundaries. Once your orders are set, the market does the rest of the work. The moment either your profit target or your stop loss is triggered, your job for the day is mechanically complete. We enforce a strict circuit breaker. If you hit 5 stop losses in a single morning, you must shut down your computer immediately. You protect your capital and you try again tomorrow. Professional day trading is an exercise in precision. More hours in front of the monitor will not yield better results. Staring at charts past 10:15 a.m. only leads to overtrading and degraded decision-making. Your assignment is to practice this routine tonight. Open your charting software, locate 3 Nifty 50 stocks resting on a rising 44 SMA, run your risk math, and drop your findings in the comments below. Achieving consistency in the market requires discipline, not a magical indicator. By setting up the night before, calculating your risk flawlessly, and adhering to strict exit rules, you control the outcome. Follow the process, take your profit, and walk away.